Inflation appears to be a hot topic, with several countries experiencing higher than normal inflation. Why? The biggest reason, of course, is the global epidemic of the last 2 years, and the resulting supply chain issues have caused a surge in demand and price rises everywhere. Certain governments around the world have raised interest rates to combat runaway inflation. In the United Kingdom, for example, the Bank of England recently raised interest rates from 0.1% to 0.25%. But what is the underlying theory? This is what we'll look at in this video. Hey, welcome to Stock Market Mate. Today we'll talk about the relationship between inflation and interest rates. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Because interest rates are the major instrument used by the Federal Reserve, the United States Central Bank, to manage inflation, they tend to move in the same direction. The Federal Reserve Act requires the Fed to foster maximum employment and price stability. Since 2012, the Federal Reserve has set an annual inflation target of 2% to meet the stable prices component of its dual mandate. Because a protracted decrease in prices, known as deflation, can be much more damaging to the economy, the Fed seeks a positive rate of inflation, defined as a sustainable rise in the overall price level for goods and services. The positive level of inflation and interest rates also allows the central bank to respond to an economic slowdown by lowering rates. What is inflation? To begin, what exactly is inflation? In general, inflation is defined as the depreciation of a currency and the subsequent rise in the price of common goods and services. Bread, for example, cost £16 in the United Kingdom in 1975. It will be roughly £106 in 2021. As prices rise, the purchasing power of the currency declines. Using the same example, 160 now would have purchased 6.5 loaves of bread in 1975. A consumer price index, or CPI, can be used to calculate the rate of inflation. Typically, high inflation makes it difficult for firms to determine the correct prices for their products and for consumers to manage their expenditures. If it is excessively low, individuals may not spend as much because they expect prices to decline, preventing the economy from growing. What causes inflation? Inflation is caused by a rise in the supply of money, which can occur through several causes in the economy. Monetary authorities can boost a country's money supply by printing and distributing additional money to citizens, devaluing or lowering the value of legal tender currency, creating fresh money as reserve account credits through the bank system by purchasing government bonds on the secondary market from banks, the most common method. Advantages and disadvantages of inflation. Inflation can be viewed as either a positive or a terrible thing, depending on who you ask and how quickly the shift occurs. Pros. Individuals who own tangible assets, such as real estate or stockpiled commodities, valued in their native currency may like to see some inflation, since it improves the value of their assets, allowing them to sell them at a greater price. Inflation frequently leads to firms speculating on hazardous initiatives and people investing in company stocks because they expect higher returns than inflation. An optimal degree of inflation is frequently suggested in order to encourage consumption rather than saving. If the purchasing power of money declines with time, there may be a stronger incentive to spend now rather than save and spend later. It may encourage expenditure, which may promote a country's economic activity. A balanced approach is thought to keep inflation in a desirable and optimal range. Cons. Buyers of such assets may be dissatisfied with inflation because they will have to pay more money. People who own assets denominated in their home currency, such as cash or bonds, may dislike inflation since it reduces the real worth of their investments. As a result, investors wishing to hedge their portfolios against inflation may choose gold, commodities, and real estate investments trusts, or REITs. Another popular way for investors to profit from inflation is through inflation-indexed bonds. Inflationary pressures that are both high and fluctuating can be devastating to an economy. Businesses, workers, and consumers must all consider the implications of rising pricing when buying, selling, and planning. This adds another layer of uncertainty to the economy since they may be wrong about the rate of future inflation. The amount of time and resources spent investigating, estimating, and changing economic behavior is projected to rise in line with the overall level of pricing. This is in contrast to genuine economic fundamentals, which invariably impose a cost on the economy as a whole. What are interest rates? Let us now turn our attention to interest rates. So what exactly are interest rates? Interest rates indicate the cost of borrowing or the benefits of saving. If you borrow £1,000 from a bank at 1% interest rate, the total amount you'll have to repay is £1,010, an additional 1% on top of what you borrowed. On the other hand, if you save £1,000 at a 1% interest rate, you will earn £10 after a year, for a total of £1,010. When we refer to interest rates in the news, we usually mean the base rates set by the Bank of England in the United Kingdom, which have a large influence on the rates you can borrow and save at from high street banks and other organizations. How does the Fed use interest rates in the economy? Interest rates are used as a monetary policy tool by the Federal Reserve and other central banks throughout the world. The central banks can impact many other interest rates, such as those on personal loans, corporate loans, and mortgages, by increasing the cost of borrowing among commercial banks. This raises the cost of borrowing in general, cutting demand for money and cooling a hot economy. Lowering interest rates on the other side makes it easier to borrow money, so encouraging consumption and investment. The relationship between inflation and interest rates. So, to return to the original question, how do inflation and interest rates interact? So what is the connection between them? As an example, suppose interest rates are lower than typical. Because interest rates are low, this encourages consumers to borrow more and save less. Borrowing is cheap, but saving is less rewarding. What do people do as a result? When interest rates are low, people tend to spend more. They consume more, go out to eat more, finance their automobiles, take vacations, and so forth. Overall, there is a higher demand for products and services. As a result, the demand becomes greater than the supply. Increased demand for the goods and services allows them to raise their prices, and price increases, as you know, increase the rate of inflation. Now consider the opposite. What if interest rates are greater than usual? Higher interest rates, on the other hand, encourages consumers to save more and borrow less. Borrowing is expensive, but saving and putting money aside is rewarding. As a result, it is exactly what people do. They don't go out as much, don't take as many vacations, and instead save their money for a rainy day. As a result, there is reduced demand for general goods and services. This means that the prices of those products and services must fall, resulting in lower inflation or even deflation. How interest rate changes affect inflation. When the Federal Reserve raises its benchmark federal funds rate in response to elevated inflation risks, it effectively increases the stock of risk-free reserves in the financial system, restricting the money supply available for the purchase of riskier assets. When a central bank lowers its target interest rate, it effectively expands the money supply available to buy risk assets. Rising interest rates discourage consumer and company expenditure by increasing borrowing costs, particularly on regularly funded large-ticket items such as houses and capital equipment. Rising interest rates also have a negative impact on asset prices, offsetting the wealth effect and making banks more cautious in lending decisions. Finally, higher interest rates indicate that the central bank will continue to tighten monetary policy, dampening inflation expectations even further. The bottom line. Interest rates and inflation tend to move in the same direction, but with lags, because policymakers need data to forecast future inflation trends, and interest rates take time to fully impact the economy. Higher rates may be required to manage growing inflation, but slowing economic development often decreases inflation and may drive rate reduction. The Fed sets the rate it pays on banking reserve accounts to target a range of the federal funds rate. Well, that's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!